Ladies and gentlemen, welcome back to Boss Economics World, your almost too realistic window into how our brilliant leaders are managing their way through another economic minefield. Yep, we're back in the headlines again, and surprise, surprise, the culprit is still the US debt ceiling. The more things change, the more they stay the same. So, let's dive into today's slow-motion train wreck, otherwise known as the Great Debt Ceiling Showdown 2.0, now playing again for no good reason. For those of you not already watching this aftermath on repeat, get this. With around $36 trillion of debt hanging over our heads, nothing too crazy, the United States government is once again out shopping with a maxed-out credit card. Now, I don't know about you, but at some point, even a gold-plated, unlimited card is going to tap out. But rather than face their junky spending habits, our government does what it's best at. They bicker, stall, and pull some last-minute financial gymnastics just because Congress doesn't want to do the obvious thing, either raise or suspend the limit, as if that will solve all our massive budgetary problems. Former Treasury Secretary Janet Yellen, outgoing hero sure to be replaced by another, we'll get to that guy later, warned us, once again, of catastrophe. Starting January 21st, Treasury's activated its extraordinary measures. They've essentially unsheathed their emergency accounting toolkit. You probably recognize this drill. Treasury dips into specific retirement and other investment funds to delay the inevitable crash the debt ceiling would cause, hoping Congress will wake up before it all comes tumbling down. Sound familiar? At this point, it's almost like watching a bad rerun from your favorite sitcom, but without the laughs, and with serious consequences. Yellen sent that now familiar letter to lawmakers, as politicians from both sides of the aisle pretend they somehow didn't know this moment was coming, again. In her message, she says, with a carefully measured, respectful urge, that lawmakers need to act promptly to protect the full faith and credit of the United States. Well, go figure, Janet. But hold on, this isn't her first notification. This lovely dance with the debt ceiling déjà vu dates back to as early as January 2nd. By all accounts, this is likely her last hurrah since she's set to hand over Treasury keys to, wait for it, Trump's new pick, Scott Bessent. Bessent says he's got it all under control. There'll be no defaults on his watch. Sounds a bit optimistic, doesn't it? Kind of like telling a sinking ship, hey, don't worry, we've only got one hole, I'll take care of it. Here's where the real fun of all this begins, the stock market circus. Wall Street, being Wall Street, is in the midst of handicapping the X-date, wondering when exactly this bomb could finally go off. Some financial wizards, using our favorite math magic, are estimating July or August 2025 could see the big blow-up if Congress doesn't act. As usual, in moments like these, jittery investors start pulling out of Treasury bills, the very financial backbone propping up confidence in the US government, leading to kinks in the bond market curve. Because why on earth would anyone invest in financial instruments due right around the moment of potential fallout? Around here, we call that a recipe for disaster, but in polite economist circles, it's called market vulnerability. Let's get one thing straight, this debt ceiling circus doesn't stem from some insane, inexplicable external threat. No. This chaos is a self-inflicted wound, a product of flawed governance, poor economic planning, and, above all, political gamesmanship. Here's the underlying problem. Systemic dysfunction. The debt ceiling is essentially an arbitrary cap, a self-imposed economic trap. If we know the government will always spend more than it earns, why has Congress designed such a flawed construct? Worse yet, it uses that flawed construct as a political football, treating America's economic well-being like a pawn in some Washington chess game. Political paralysis. Every time the debt ceiling issue rears its ugly head, Congress is as useless as ever. Both sides stall until the last second, all while the taxpayers and financial markets pay the price for their delays. Because of political infighting, regular budget negotiations devolve into finger-pointing over who's responsible for most of the debt, spoiler alert, all of them. Let's break this down further by looking through three key lenses. 1. The policy band-aids, extraordinary measures. First, the extraordinary measures Yellen and Treasury will be taking involve dipping into various federal funds. They'll be redeeming portions of, and suspending full investments in, the Civil Service Retirement and Disability Fund, and the Postal Service Retiree Health Benefits Fund. Essentially, the government asset strips existing obligations to itself in order to buy time. Kind of like taking out of your savings account to pay your rent, even though there's not enough money in there to pay for the rest of the month. You're borrowing from the future to fund the now. These stopgap measures, by opting not to make certain investments today, with the full intention of replenishing those funds later, might work for a little while. People rarely complain about funds like the Civil Service Retirement Fund, but it obscures the real issue. What most folks seem not to understand is that all these gymnastics in the Treasury's accounting department will not stop the fundamental risk of national insolvency. It doesn't protect anything long-term, it only delays what increasingly feels like the inevitable. 2. Debt and deficits, America's never-ending story. We can't talk about the debt ceiling without addressing the glaring issue of American fiscal irresponsibility. The ceiling is set at around $36 trillion. In 2023, the national debt stood at 98% of the GDP at over $33 trillion. Yikes. We're running back-to-back massive deficits. In fiscal year 2024, the U.S. government posted a deficit about $1.7 trillion, a stark reminder that there's no balance between what we take in and what we spend. To get this into perspective, the federal government has had budget deficits nearly every year since the early 1970s. In recent years, we've seen deficits repeatedly exceeding $2 trillion, fueled by pandemic relief funds and rising mandatory spending for programs like Social Security and Medicare. Add in various forms of stimulus spending on top of costly infrastructure bills, bloated military budgets, and non-discretionary federal expenditures. Unlike for an individual or a corporation, the government doesn't immediately pay for its debts out of income. Instead, it issues Treasury bonds, effectively borrowing from its future. But given our current model, the future has a pretty grim bill waiting, unless major reforms materialize. 3. Global implications. Is the U.S. still a safe bet? There's a prevailing belief in markets right now that American treasuries are still the gold standard of safe, reliable debt. Here's why: even with all the chaos, because the US dollar remains the world's reserve currency, global investors continue pouring capital into treasuries, it's still hard to imagine a total collapse in the near term. However, repeated standoffs on the debt ceiling or failure of Congress to deal promptly with this issue erodes long-standing trust. Consider this: in 2011, an eerily similar mess with the debt ceiling caused Standard & Poor's rating agency to downgrade the United States credit rating from AAA to AA+ for the first time in history. Sure, markets may be used to the debt limit brinksmanship by now, but any possible default will have major implications, not just on Wall Street, but globally too. It could trigger higher interest rates on future borrowing, spark inflation, and push investors towards other currencies or asset classes. Geopolitically, America's financial strength is key to its influence, and consistent economic uncertainty chips away at its standing. This isn't just a theoretical risk; economic credibility is the bedrock of American soft power. Now, Trump's appointee, Scott Bessent, sounds pretty firm in his stance: no defaults, everything will be just splendid. But remember folks, this isn't Bessent's circus yet. He's sitting on the hot seat watching Yellen take the fall one last time, and boy, is he in for a ride. The Republicans have unified control heading into this debacle, controlled both chambers of Congress and the White House, and presumably have an easier path toward dealing with this ceiling issue on paper. But there's internal party turbulence ahead: deficit hawks versus MAGA spenders versus centrists. Historical precedence shows us that even when one party controls the key levers of power, fiscal fights are never easy. And with past talks of government shutdowns and hostile budget propositions, expect a contentious debate and potential slowdowns if they can't align internally. Enough with the delay tactics. All sides, left, right, centrist, all agree something needs to be done here. The question is about how to go about doing it. The debt ceiling itself is a flawed concept because it makes what should be responsible governance a high-stakes dramatic showdown every few years. Let's propose 3 main solutions. 1. Long-term fiscal structural reform. It's time Washington grappled with the real issues: tax reform, entitlement spending, military expenditure, and long-term government revenue. Neither party seems willing to confront these hard truths, but change is necessary. 2. Scrap the ceiling altogether. The ceiling serves as nothing but an arbitrary political football. Some economists call for repealing it altogether. It doesn't technically block spending, it just focuses congressional dysfunction right before we hit it. 3. Automatic mechanisms. Consider implementing automatic adjustments to the debt ceiling, tied to real metrics like economic growth or inflation. Less political posturing, more handling economics pragmatically. At the end of the day, all this economic maneuvering, the extraordinary measures, the ever-looming debt limit, and the successive nominees for Treasury Secretary getting paraded out to save the day, amounts to a band-aid on a bullet wound. The reality is we have a massive economic overhang that no technician's stopgap will fix. This situation boils down to political gamesmanship where everyone wants to hold on to power, but no one actually wants to solve the underlying problems. So here's my personal advice: don't buy into the false hope of temporary financial patch jobs. If the US economy's fundamentals aren't reformed soon, the house of cards will fall. And that, my friends, would make the fallout from this cycle's debt ceiling drama look like child's play. Stay economically alert. There's more turbulence ahead, and only the uninformed will be caught off guard. You don't want to be one of them.